inflation isn't experienced by everyone at the same rate.
Of course.
So coming out of the 2008, 2009 crisis, there was a bunch of studies done that show the bottom 40% of Americans experience somewhere between 6 to 10% inflation levels, which is higher than where we are today, right?
Yeah.
Obviously. But the top didn't experience 6 to 10%.
Yep.
But the difference is that the people who make the decisions are at the top. And so what they do is they look around and they say, oh, inflation's not that bad. And when you look at the blended, it may seem like it's lower. But the most vulnerable people in our society experience the highest levels of inflation.
Yeah, the people
because
that are spending...
the percentage of their monthly costs or expenses end up being in the highest number of inflationary goods.
Food,
groceries,
transportation,
all
housing.
So when you ask that question, I'm willing to bet right now, if you're in the bottom 20% of Americans, your inflation rate's over 10%.
Yeah.
Easily.
Scary.
Right? I mean, just think about that for a second. Even if it's only 10.5%, if you're in the bottom 20% of Americans, you probably have over a 10% inflation rate. And if you think about that, that puts you in one of the worst economic situations in the world. Top 20 highest inflation levels in the world. And it's here in the United States.
It's crazy.
And we're getting gaslit by people who literally take 2 minutes to explain to us what transitory means, and they can't figure out how to control inflation.
Yeah, he talked about transitory for 2.5 minutes, and then he ended with, well, the definition is temporary. It's like, wait, what?
Now, we're going to get to in a second why I actually don't think it's Jerome Powell's fault, right? So like I'm gonna give my guy a little out here in a minute, but I do think that it's important that we kind of stay on track in terms of what they're saying. So if we move on, Joe described, when did people start to call for Jerome Powell to be out? What happened yesterday? The Wall Street Journal's editorial board, which is a very esteemed group of people. They're considered insiders, elites. They're part of the Wall Street Journal. It's a group of folks. They come together. They write things in probably Google Docs. They have editors. They use comments. They do the headline, like very professional. And this is what they said in an op-ed yesterday. Quote, one trait of the modern Fed is never to take responsibility for financial and economic problems. The financial panic of 2008 was the bankers' fault. The historically slow expansion after 2009 was the fault of fiscal policy. And now the inflation surge is due to forces beyond its control. If Powell and the Fed won't accept responsibility for the price levels, which is central to the Fed's mission, maybe it's time for a Fed chairman who will. Now, again, this is not me screwing around on the internet. This is not my brothers texting this to me. This is not a cat photo or laser eyes or somebody on a Reddit board or somebody saying this drunk at a bar. This is the Wall Street Journal's editorial board writing this. That's how serious this has become. Where now we have the mainstream media starting to turn on the head of the Federal Reserve, saying the modern trait or the trait of the modern Fed is to never take responsibility for the problems. But you have to admit, if you're an outsider looking in, that the Fed is more responsible than probably any other organization inside of the United States for both good and bad, because they drive monetary policy, and monetary policy is, if not the most, one of the most important aspects of the economy. So if the Fed is going to claim that all of the problems, all of the high inflation is just supply chain problems. Remember, we saw AOC say this. We saw Joe Biden say this. This is a talking point that now is going to start to permeate. But good for the Wall Street Journal and their editorial board to call this out and say, no, you are responsible. You must take responsibility. That is the job of a leader, is to take responsibility for high inflation. Your job is price stability. We do not have price stability. You're failing at your job. We do not have full employment. You're failing at your job. Fix it. Or maybe we need a new Fed chairman. Now, when you start to think about that, that's a pretty crazy place 12 months ago to think we would be today. But even crazier is the director of global macro at Fidelity. Again, a very esteemed person, a very well-respected person, somebody who most people would look at and say, I would like to know what that person thinks about the world. Had a tweet thread this morning that is absolutely epic. And so when we look at what he says here, he starts out with a perspective on Bitcoin. Claims that it's an aspiring asset class that looks to be coming of age, much like gold in the 70s, when it was also an asset class as a teenager, growing into adulthood. And usually they're full of potential, but they can also wreck your car, so you got to be careful. And so after Bretton Woods in the 70s, even though it was a known commodity, gold was extremely volatile on its way to a 20x return, and it suffered large drawdowns quite regularly. And he describes Bitcoin as being a relative newcomer. It's got scarcity and network effects. And so it makes sense to him that the upside of Bitcoin is greater than gold, as are its drawdowns. And that's the definition of price discovery. Remember, this is the director of global macro at Fidelity. And then he continues in the thread, and he states, below, I show Bitcoin since its 2019 low against gold during the 1970s. Price analogs are highly subjective, calls out any sort of bias, but clearly gold's price discovery was highly volatile, much like Bitcoin today. By this measure, Bitcoin's current 50% drawdown could be seen as a bump in the road. He then goes on to show, at the risk of cherry picking, the timing of the above chart fits with my supply-demand models below. Both charts suggest that Bitcoin is not done with its current bullish phase. We now are seeing what I would consider the unraveling of the well-driven, well-accepted consensus narrative in the economy. We are seeing the Wall Street editorial board call out the Federal Reserve chairman and say you're not taking responsibility for the impact of the decisions that you and your organization are making. We're seeing the director of global macro at Fidelity start to talk about Bitcoin being something that is going to grow into a full-on asset with more upside than gold had in the 70s. And this is all with the backdrop of the Federal Reserve's balance sheet continuing to grow to the sky. It looks like a kindergartner. If you said to them, draw some lines, just make sure it always goes up and to the right. And when you look at that balance sheet, it hit another all-time high last week. We are now over $8.2 trillion on the Federal Reserve balance sheet. We just continue to see, look at this, it just continues to go up. There is no stopping the growth of that Fed's balance sheet. There's nothing that suggests it is going to stop. But it's not just in the United States either. This also is happening around the world. It's all relative. And so if you look at the ECB's balance sheet, for example, you can see that the ECB's balance sheet is also growing like a weed. It's just looking for sunlight. How do I go up and to the right as fast as possible? And so when you have a dollar being devalued at a historic rate, a balance sheet hitting an all-time high, the stock market hitting an all-time high week after week after week, and you have other central banks around the world also having balance sheets hit all-time highs, you realize that it's all one big charade. The balance sheets are all growing to the sky. The currencies are all being devalued, and it's all a relative rate. And if we go back to comments that were made, the third richest man in Mexico earlier this year said that when he grew up, it was about 17 Mexican pesos to $1 US. Today, it's 20,000 pesos to $1 US. Now, 17 to 20,000 is a big leap, but that's also as the dollar was devalued as well. And so what we are seeing is, again, a rate of change and devaluation that nobody can measure. I don't have the answers. All I know is it's way worse than what we're being told. Neither does the Federal Reserve, the Treasury, the politicians, the market participants, etc. We are in uncharted territory. And when you get to uncharted territory, what you need is you need an obsession with facts and data in a pursuit of truth. You need people who say, we've never been here before. We need to understand what's going on, and we need to do our best to make sure that the data that we are using to make decisions is accurate. But that's not what's happening. We continue to get told a story to keep markets calm, to try to make people easy and not get upset or get worried about uncertainty or chaos in the future. But what we know is that now the conversation's changing. The Wall Street Journal's editorial board is calling out the Federal Reserve chairman, and people that normally would be considered stalwarts of the financial system, like the director of global macro at Fidelity, are starting to say, might want to go look at something like Bitcoin, because I think that that actually may be a pretty good place to put some capital. And so I'll leave you with this. What is the solution? Well, at the same time that all this is happening, today on CNBC, Judy Shelton, who is a former nominee for the Federal Reserve Board, went on television. And I don't know her. I'm not actually overly familiar with most of her work. I'm sure she's a nice person, very hardworking, very well respected within the finance and economic world. But she said, quote, "I don't consider myself a hawk or a dove. I'm more a woodpecker." I keep hammering away at this idea that money is meant to be an accurate measure. It's supposed to convey price signals. My concern about the Fed's actions is that it's muddling that message. Now, again, that first sentence, I don't consider myself a hawk or a dove. I'm more a woodpecker. When you have a human-led monetary policy, you get in a situation where people are literally debating, are you a hawk, a dove, a woodpecker, or some other animal? Instead, what we need to move to a system where there is zero human interaction. And so when we had the gold standard was actually pretty effective because the gold standard allowed us to simply use gold as the underlying commodity. I don't know where we're headed. I don't know exactly where we are today. But what I do know is that a programmatic, transparent monetary policy is going to become more and more and more attractive to people around the world when they compare it in a relative basis to the chaotic, uncertain world of what will happen next.